Sunil, hi, good morning. Hope all
Right,
things
morning.
are safe at your end. Just wondering, Sunil, and just baffled with the resilience of the equity markets, even after the consistent FII selling, DI is supporting the market, and the market is holding out. What's leading to this?
I think it's a case of once bitten, twice shy, in the sense that the previous time this happened, the domestic stayed away. And then you saw the Sensex and the broader market rally rapidly, kind of a rebound. So I think this time they don't want to miss that out. So I think the domestic are sensing that the panic is slightly overdone, that there will be support coming, whether it's from RBI, whether it's from the government, whether it's from even FIIs. So I think that the domestics are being a bit more cautious and smarter and not panic reacting like they did last year, same time around. So I think that accounts for it. Second is the investor behavior. As you notice over the last few months, redemptions have come down sharply. Inflows are gradually picking up. So your net new cash into the industry, the mutual fund industry, actually is turned positive for a couple of months. So the investors giving money to the mutual funds is again something helping the mutual funds to keep buying. The third aspect is, I would say that the underlying strength of the economy from a medium-term perspective, I don't think has been damaged by the second wave. Yes, short-term, you expected a summer bounce back in consumer. That may not happen. All right, short-term, there will be impacts. But bear in mind that the monsoon outlook so far is looking good. So I think that if you factor in the fact that vaccinations, right now, they are in a little bit of a pause mode because of the shortage. But in about 2-3 months, we should catch up onto that. And once we start vaccinating a significant amount of our population, I think 6 months down the road, we'll be singing a slightly different tune. So I think that that's the thing holding up, saying this is a short-term thing, it will come to pass. And every sell-off by the FIIs is a buying opportunity for domestic, I would say, economy-sensitive stocks. So I think that's where we are seeing the play. So that being said, the volatility will continue because, as you know, FIIs have dominated. So even a small outflow from FIIs, right, would lead to a lot of volatility in the markets.
The question is, what do you buy? Because while IT and pharma are the only clear trend, and perhaps metals as well, although they also have run their course pretty hard so far, but the rest of the sectors, consumption in particular, is facing the heat from the input cost price pressure. And, it's a bit of a catch-22 situation on whether to protect their margins or see a dip in volumes.
Absolutely. And I think it's time to be neutral around the whole consumer pack, whether it's FMCG, whether it's consumer discretionary, whether it's auto, and even housing. I would say that in the short run, given the way the second wave is spreading, and while Mumbai and Maharashtra have shown that you can control and bring it under control shortly, I think the places like UP, with a vast population, are a very different kettle of fish. So I think for a short while, for the next 3 months, I would say going neutral on consumer is a better bet. Like you mentioned, the risk factors in terms of input costs, as well as the fact that the valuations had already factored in a summer bounce back in consumer, which I think may not play out to the extent possible. So definitely you stay neutral on the consumer pack. So your question on what to buy, I would still back banking. And the reason for that is in banking, you have a variety of plays. You have the private sector banks, well capitalized, who are taking advantage of every RBI move in terms of liquidity and all to smartly manage. You have the PSU banks, which have the reach, but which have been undervalued. And so there is a bounce back. And then the smaller private sector banks, this is the time when the opportunity is there for them to take advantage of RBI support. I think so RBI is a key player. And in that sense, knowing that RBI will proactively support the first beneficiary, the first line recipient of RBI's largest is going to be the banking system. So I would say you can't go wrong if you keep consistently buying the banking sector.
Sunil, morning. Good to connect with you.
Good one. Yeah.
Sunil, I'll tell you what I'm worried about. What I'm worried about is what will happen to retail delinquencies. On the corporate side, I think the balance sheets are better. Corporate banks have ability to lend, they have buffers. But on the retail side, because of confusion, chaos, last time the lockdown in a sense had an impact on income, but right now the casualties will have an impact on future loans, ability to pay back. The point I'm trying to perhaps make here is the last time there was, in the first wave, there was an income issue. Right now there is going to be a challenge in terms of what happens because of the mortalities.
Yes, partially I agree with you and partially I don't, Nikhil, because last time the impact was driven by a severe lockdown. And this time I don't see the government stepping back. They'll do localized periodic lockdowns and ease the economic burden. So I think the economy is taken slightly a higher thing than medical and health in the government's minds. It's a very, very tough stance to take, but they're actually taking that. So I think the economic impact, right, will not be as bad as the previous lockdown, whether it's on income or expenditure, one. Second aspect is that the level of insurance coverage and the clarity around COVID covering insurance. I think what's happened is that initially the insurance companies were avoiding COVID claims. But I think the reality that you can't progress without covering that, and lots more people adding COVID as a clause in their insurance clauses, means that the financial burden of this, right, will not be as severe on the families. Yes, the death is very heartbreaking and it's a media thing in terms of the visibility, but the number of deaths, right, I think are fairly controlled, if I may say. It's not that widespread. I know the media is making a big scene of it and it looks like that, but look at the percentages, right? I think they are not that severe as to affect. So insurance coverage, the fact that treatment, now if you look at it, they've approved recently 2 more drugs, right, to treat mild and moderate. So the vaccination cum treatment for mild and moderate COVID cases, preventing them from going into severe hospitalization or to death, is something else which will help control the risk behind what you say, Nikun. So I'm a little more optimistic on the front of retail, saying that the retail defaults, and RBI is also there to come and support by, if need be, extending restructuring moratorium for all the retail people. So I think that that's a little bit overdone. I don't expect the retail pain to be that much in terms of this, especially since I don't expect job losses. Industry is also much better prepared, Nikunj, this time to deal with the crisis than previous. So I think they're all taking the smarter decisions to keep their industry stable and maybe at a lower operating level, but continuing rather than a complete shutdown as was last year. So I think we have learned from the last year's crisis and our responses should be much better this time.
Sunil, at what point in time markets would say, look, the commodity inflation will hurt us? While steel stocks are going through a great moment, these stocks have never seen these levels. These companies have never seen these kind of profits. Where do you think it would be law of demand and supply which would kick in? I mean, you cannot have such high steel prices, cement prices, cotton prices, cocoa prices, or corn prices.
So if you look at the basket, I think Indian inflation, there are 3 components to inflation, right? First, there is a supply side and the demand side. So that splits into 2. But in the supply side, you have domestic inflation and imported inflation, right? Now you look at, so it's 3 components, right? Imported supply side, domestic supply side, and you have the demand side, which is entirely domestic. So if you disaggregate these 3 factors and look at it, right, the imported inflation comes from the fact that the metals pack is delinked from a domestic demand supply equation and is determined by the prices in LME and hence the demand supply overseas. Now there, what led to the metals rally was a Chinese pickup post the crisis, right, the bounce back. But there, as you can see, the Chinese credit cycle is rapidly expanding and the government is cooling it down. So we don't expect the China factor to drive commodity metals prices any further. So where will then those prices rise from? Only if the Biden government's $2 trillion infrastructure program gets fast-tracked, put in, and America leads the next line. Now, I don't see that yet happening fast. While the announcement has happened, it is going to take time to play out. So the imported commodity side inflation on this metals pack, I expect it to be stabilized. Second aspect is the imported inflation. There's another aspect, which is crude. And as you can see clearly in crude, there is a balance between survival and growth. So all the OPEC plus Russia plus US are coming down and keeping supply stable so that everybody survives, nobody super profits, but nobody collapses. So I think a stable scenario of supply for oil means a stable scenario of prices for oil. So I think, so from an imported inflation perspective, right, I would say that reasonable level of comfort is there from the markets. For the domestic supply side, one of the main things is agriculture. And with the news of a good monsoon coming through, I think food prices, which are one of the key components of domestic supply side inflation, would be reasonably under control because the supply would come in there at a reasonable place. So I'm not so worried about the supply side. And on the demand side, with the second wave, you've hurt demand even more. So I think inflation fears today are fairly reasonable. And I would actually say that the market is currently, while there is a risk factor on inflation as an overhang, practical reality indicates that over the next few months, RBI is actually going to not use inflation as a stick to raise rates or change their accommodative stance. So the other aspect of inflation affecting the markets is whether a fear of expected inflation will make RBI to reverse its stance. Even that risk is fairly far away. So I think the markets are reasonably complacent on the inflation side, right? So the key figure then to track, according to me, is how fast the US implements their infrastructure and comes back. Then you'll have imported metal inflation feeding through into the Indian economy. I think that's where it is. So that's the trigger to watch for. And unless the monsoon forecast reverses, the coming weeks, they say, no, we made a wrong estimate and we're actually going to have a shortfall of the monsoon, then domestic inflation supply side will pick up. But demand side inflation pull, I don't expect that because of the COVID second wave and a potential third wave in the anvil.
When we spoke last time, you were quite optimistic on cement and autos. Have you changed your positioning?
I have continued to be optimistic on cement. I've changed auto to neutral from optimistic. Basically, the second wave and the summer, what we expected to be a boom for the auto, I think that's calmed down because of the second wave and its widespread impact. So auto, I've moved to neutral. Cement, I continue because I still believe that the government's infrastructure program, road laying program would continue despite all of the crisis because they'll need to keep providing those NREGA jobs and the construction activity will go through. So cement, I continue to remain bullish.
Sunil, we've been speaking for so long, and I know that you're an eternal optimist. I want to go back to what you were talking about with regards to media painting a picture, and I just want to, I do tend to disagree slightly. I don't want to be a pessimist, but there are also a spate of reports that suggest that we may not be factoring in perhaps implications of what we're seeing now. I guess in light of that, as a retail investor, what I want to know is how to safeguard myself, even if there is an opportunity, for growth, as you're saying, for things to normalize, let's say 6 months down the line and then onwards, there is still going to be a lot of pain in the interim. So as a strategy, what would you recommend? What would be the immediate implementable actions that you would suggest to a retail investor right now?
So two clear actions. I would suggest them to reduce their equity component because equity is going to be volatile for the next 6 months. So I would suggest a 70-30 equity debt component, right? And in debt, keep the debt short term. Don't go into long-term debt. So money funds, liquid funds, anything short-term funds, ultra short-term, keep 30% there. And this 70% of equity also, I would recommend going into the dynamic asset allocation, balanced advantage, hybrid category, which bring in a further debt there. So actually, if you look at it and let's say that a balanced advantage fund today would be carrying only 40% equity. It carries 60%, but they put something in arbitrage to make the equity taxation. So that's actually very neutralish, liquid kind of a scenario. So what I'm saying is effectively then you're looking at a 50-50, but don't do a 50-50 yourself as a retail investor because there is a time when you need to quickly add on equity and a fund manager will be in a better position, quickly reallocate the portfolio than a retail investor because having put in debt, you have a 3-year lock-in because of the taxation, right? You get long-term capital gains only after 3 years. So don't overdo the debt. Let the fund managers play the debt card. So I would say 70% equity, but 70% equity, you keep a significant portion in asset allocation, dynamic asset allocation funds like Balance Advantage, so that fund manager you will have technically a higher debt allocation today, but quickly it can be shifted into equity at a fund manager level. That's the right situation. And the third thing I would say is keep staggering your investment. I would still say that SIP and STPs are a better bet to play this market on the equity side than putting in a lump sum. This is just for the next 3 to 6 months.
Okay, that's sound advice coming in, and in fact, great to get that sense from you on really how to go about it. In lower equities, also, what should one avoid or even book exits from right now? Anything that one should perhaps get out of where you see vulnerability given the ongoing environment, and some short areas where really one shouldn't look to invest in at the moment?
So I would say that, if you look at the run-up of the last 1 year, 2 years, and I think the small cap segment has run up a lot. And I think until we see us coming out of this crisis, I think you can book profits in the small cap segment, shift it into the mid caps, because mid cap is a little more balanced in terms of exposure to sectors. Because overall small caps has a high exposure to industrials, and because of the pharma hookup, it's also gone up. So pharma is a place where actually I would recommend booking profits, because it's a short-term bounce back rally because of the second wave, because RBI announced these measures. I would actually say that pharma is a good time to book profits. It's a tactical allocation, which you will get out moment you see the growth factors coming in, right? I would say that pure small cap at the end, it's a good time to book profits, shift them into mid caps, and large caps again will be volatile because of the FII implement. So mid caps is actually the sweet spot to play today. And sector wise, as I said, to me, despite the run up in the pharma, for me, pharma is not a long-term play. And I think it'll be good to book profits in pharma. And I also see NBFCs and insurance going through a slight bit of pain with the second wave in terms of what Nikunj mentioned, that there'll be some amount of retail default rates going up, delays. There could be some amount of insurance spike because of the COVID claims on the insurance companies. So those are all spaces for the short term where you can stay away and re-enter at a future time. Because the small cap index, post the December 17 is actually come up in terms of forward valuation almost to the large cap. Whereas the mid cap is still trading at a 10% discount to the large cap index. So that makes sense. That's why.
Would you buy insurance stocks, Sunil? They have been underperforming, but ultimately insurance is something where one side, okay, there would be claims right now, but on the other side, the demand is going to be high. I understand that even though insurance premium has gone higher, the demand has been relentless. I mean, all of us have fear now, and insurance and fear as a product always complement each other.
Yes, but you got to have at least a 3 to 5 year perspective. I'm saying the short run, there will be more volatility, because as the claims ratio picks up, right, they'll have to readjust their thing. So we could get a chance to buy insurance even cheaper than today. So I would say that if you have a 3 to 5 year perspective, you can keep steadily allocating a little, because you'll definitely get it at better prices. But if you want to allocate a lump sum, I would say you'll actually get a better day to buy it than today. But long term, I share your view that insurance awareness among the population, the willingness to pay higher premiums, and the fact that that's such a big help in these times is a significant shift in the thought process of the population. So overall, I would say having insurance in your portfolio is a good thing to do. But just that tactically, I feel that, there could be better price points coming up in the next few months.
What are your outsides positions? One is cyclicals and industrials. Apart from that, what is the outsides position where you're significantly higher than the benchmark?
Banks and IT. Both of them, I'm overweight.
Okay. Let's understand IT. 25 times, 30 times is the average P multiple for large cap stocks with a 10-12% growth. Are you betting on rupee depreciation, or are you playing safety? I'm
playing three things. Rupee depreciation is one, safety is two, but the third is the fundamental factor that IT spends abroad, right, are going to rise because of the fundamental nature of 5G, Internet of Things, the shift to cloud, the fundamental work from home shift. So I think IT is now it's a bigger part of a large corporation's budget will be spent on IT. And that's where I think the growth rate of IT is sustainable, right? So I think that comfort factor, ultimately, you don't mind paying a high price as long as the growth is predictable. And I think that predictability of the growth is what makes me be overweight on IT. In addition to the fact that I believe the rupee is due for depreciation over the medium term. So I think at least a 5% per annum uptick on these stocks just on their earnings from depreciation is something you'll factor in. So, and the safety element, yes, all the three.
Sunil, great to have you on the show. Thanks as always for taking the time out and chatting with us with your market perspective.